Hey traders, Jason here from Lever Brothers. So I've talked about some quant studies that have pointed to higher prices 6 months out, 12 months out. I've done this at Lever Brothers. I've done this on Twitter, reposted some stuff, posted some studies. Studies that say 2024 should be a pretty good year, even if we have a soft spot in the first quarter or some point in time as Q1 turns over to Q2, the overall year should be pretty good. But we've recently had a few studies trigger that would imply that this might not be the case, that we actually should be a little bit, I don't want to say concerned, but it's not a slam dunk that we're going to have a great year. So because I don't want to be biased and I don't want to only post certain studies to back up or confirm what I'm hoping happens, I want to be fair and just post everything, and then you can make your own decision, or at least you can actually know that you're getting the full story rather than just a very biased and a biased subset of what is all out there. So I'm going to start with the Santa Claus time period. I'm going to talk about what has happened at the beginning of this year. 2024 has not gotten off to a great start, and this does have implications for the entire year. So let's get through it. Let's get into it. All right, so first is the Santa Claus time period. Santa Claus time period is the last 5 days of the year and the first 2 of the following year. So this is a study from 1998 to 2017, so 20 years. This is what, these are the dates. This column is what the market did during that time period, and then what the market did for the entire month of January. So it turns out that how the market does during the Santa Claus period does have implications for January, and then that has implications for the entire year, which I'll get into next. So when the Santa Claus time period is up, which happened 10 out of the 15 years, the market for the month of January was up almost 1%. But when the Santa Claus time period was negative, January was down 5 out of 5 years, and the average loss was 4.4%. Okay, so an up Santa Claus period just simply says it's going to be a typical January, but a down Santa Claus period says we're very likely to get not only a down month, but it's actually going to be down quite a bit. This year, the Santa Claus period was down almost 0.9%. Okay, so that's enough to be noticeable. So why is this important? Why is January so important? Here is the January performance as a function of what, this is not January performance, this is the all-year performance as a function of what happens in January. So the green line is what typically happens when January is an up month, and the mustard color line is what happens for the entire year when January is a down month. So if here's the end of January, okay, so obviously if you got an up month, it's starting off with a head start, and a down month, it's starting off below zero. When the month of January does well, the entire year tends to trend up and do fairly well. When the month of January is negative, the market tends to be pretty flat for the entire year. This is on average from 1950 to 2019. Okay, so the Santa Claus period implies a performance for January, and then January implies a performance for the entire year. This year, the Santa Claus period was down, which implies a higher odds that January will be down, which then implies that we're going to have kind of a flat year. All right, let's move on to the next study. This is a study for the first day of the year. So this is first trading day of the year, and then how the entire year performs. Okay, you might not think the first year is really that important. You could believe that, you cannot believe that. I'm just going to objectively tell you what the numbers are. This is from 1998 to 2017, so 20-year period. So these are stats for when the first day was up, and these are stats for when the first day was down. So when the market posts a gain the first day of the year, the entire year is up 80% of the time, an average of 14.2%. But when the first trading day of the year is down, the win percentage for the year drops to 60%, and the average return is below zero. Okay, so the first day of the year, you can argue all you want, like whether the first day actually means anything. there's 20 years worth of stats say they actually do. This year, the first day was down 0.57%. Okay, so doesn't mean the market has to be down. It just instead of having an above average year, it's going to have some struggles. All right, next up, these are first 4 days of the year. Okay, from 1928 to 2016, this is the S&P's return the first 4 days of the year, obviously all negative. The question is what happens when the first 4 days post a loss. This next column here is the January return, and this is the full year return. Okay, so when the market, these are all situations where the market already has posted a loss for the first four trading days of the year. The win-loss rate for the month is 41% up, 59% down. For the year, it's 47% up, 53% down. So both of these are well below average. And then the average gain and average loss is 4.5%, 4.1%. The average gain and loss for the full year is 14.8% and 11.1%. Okay, so typically in a typical year, the odds of closing up, market closes up about 75% of the time. So if the first 4 days are a loss, and then the full year, those stats say, at best you have like 50-50 chance of being posting a gain. That's significant. It's something to note. Okay, if these were positive, we'd have different numbers, but this is another negative stat / implication that because the first 4 days are down or were down, that history says, going back to 1928, that the market is going to, is higher odds of struggling this year. Now, the gain here is 14.8%, which is still really good. Okay, so it doesn't mean it has to close down. It just means the odds of it closing down are much higher. Last one. What about the first 5 days of the year? Okay, so this is a total return, S&P 500 from 1950 to 2019 for all years. The average gain is 12.7%. The market closed higher 78.6% of the time. Now, when the first 5 days are negative, the percentage gain drops. The win rate drops to 60%, and the average gain drops to 4.6%. When the first 5 days are positive, the win rate is about the same, a little bit higher, and the average is about the same, a little bit higher. Okay, so if the first 5 days are positive, it's basically just a typical year. When the first 5 days are negative, the odds of you having an up year drop, and even when you do have an up year, the you're most likely to get a smaller gain. So this year, the first 5 days were down 0.13%. Okay, so it is what it is. The Santa Claus time period was negative, which implies a negative January, which implies a flat year. After January closes, the first day of the year was down. First 4 days were down. First 5 days were down. Okay, you can ignore these if you want, or you can keep in the back of your mind that 2024 is not going to be a slam dunk just because there's a lot of studies out there that point towards higher prices in the middle and at the end of the year, and the market's near its highs and momentum is pretty good. There are some reasons to be a little bit skeptical. Okay, keep in mind. And just ultimately listen to the message of the market, do what it tells you, don't argue with it. All right, hope you got something out of this, and I'll see you next time.